Everybody, all is well. Hope everyone's having a good day. A little chilly around here, raining, but it's all good. I forgot to shave this morning, so it's a little rough over here, but it'll be good. It's all good. Hope everyone's having a fantastic week, and you're doing well wherever you are. And again, just we're gonna have a great session today. Today we're gonna talk about funding, financing, getting money for your deals. And so the title is going to be called Funding Your Next Deal. Let's have a look. See if I can put it up. This is the title, Funding Your Next Deal, The New Realities in Uncertain Times. And the uncertain times, obviously, we're in a recession. Well, at least it's a downturn. And normally a lot of things happen when you're in a downturn as it pertains to raising money or getting money. And that's what I'm going to talk about today. Some of the pros and cons of different alternative strategies for raising money. And and so on. So again, this is Dr. Joe Asimo on this Wealth Wednesday. Let me just had dinner. So okay. So anyway, the reality is that we kind of going through a downturn. This is my fourth market cycle that I've been through, and the ups and downs is what I call a cycle. There's the first cycle, I think, is in the late 80s, and there's been three more since then, all the way through to 2008. So this is probably the fifth cycle that we're going through, at least I'm going through. So I have a pretty good idea how this kind of plays out, and how to sort of position yourself to be a beneficiary of a market cycle as opposed to a casualty of a market cycle. There's going to be a lot of casualties as we move forward the next few months. And it's pretty ugly, especially if your strategy is such that you need to sell fast. Because as interest rates are high, financing is becoming more challenging for buyers because they need more money in order to get the funds. And as a result of that, a lot more people are being priced out. So I think that the term is affordability is becoming more challenging for a lot more people. And as a result of that, if you're a seller and you have to sell, you have two choices, really. One is to pull the house off the market and just wait until the times improve. Or you're going to have to, wait in and see if you can sell your property and so on. So if you have that, then if there are fewer buyers, what it means is that you have to become a lot more flexible, and that's essentially what I'm seeing in the market right now, is that sellers are a bit more reasonable now compared to maybe 6 months or a year ago. And so if you're ready, if you're positioning yourself to buy, then this may be a good time to jump in. There's less competition, sellers are more reasonable, and it's just there's less competition anyway. So this, obviously the cycle is that, with the economic turmoil that we are currently facing or will face, there's going to be an increase in unemployment. We all know about the layoffs. We heard about layoffs, especially in the tech sector, Facebook, Google, and a bunch of others, Amazon. There's a lot of companies that are laying off people, thousands and thousands of people. There's going to be increased unemployment. Depending on where you are, you could be hit harder than other places. And reduced wages. Although inflation is still high, it's my understanding that the wages are kind of falling behind inflation. So people are getting worse off, which means if they're getting worse off, they're going to start tightening their budgets. They're not going to be spending so much money on discretionary items, and kind of be a lot more tighter with their spending. The other thing is that banks, although it's not as bad as what it was in the 2008 cycle, they are being a lot more conservative with their money, how they lend. So credit is tightening for a lot of banks, and things are changing pretty fast. So with that said and done, from a personal financial perspective, it means that access to financing is going to be more difficult, which means that relationships with financial institutions, your relationships with financial institutions, is going to be really, really important. And the days of easy money is pretty much done. And however, there will be new opportunities for those people who I call bankable, and that's what we're going to talk about today. Is that as part of this live stream, it's really important as we move into this sort of shifting market that you take the time to get your financial house in order. I'm talking primarily to those people who are interested in purchasing during this window of opportunity as the market is shifting. And so it's now is the time, if you haven't done so, to get your financial house in order. Know your credit score, pull your credit, know what's in there, and know what banks are looking for. It's probably a good time to save some, have some savings and reserves, establish an emergency fund, and really organize your financial documents so that if you do want to apply for a loan or for a mortgage, you're able to, provide the documentation that the banks, hard money lenders, and other people are looking for, and quickly. So it's important to understand what they need, and now is the time to sort of pull those stuff together. And it will be a good time to reach out to prospective lenders if you are considering buying, because now is the time, as I said before, to to kind of get your financial house in order and get yourself positioned for this new reality that's going on. So as part of the JV programs I've had in the past, I kind of talk about different financing strategies that you may want to pursue. I think there are about 12 of them. And I really don't have the time to go through all 12 today. So I'm just going to focus on probably 3 of them. These are financing strategies in order to raise money for your next deal. So I'm going to review portfolio loans, from banks, and hard money, and also private money. That's what I'm going to focus on today. Those 3. And as I said, there's about 14 altogether. I just don't have the time to go through all of those. Maybe another session. Let me know if you're interested, and then maybe I'll do another session focused on money. So let's get going. So the first one I'm going to talk about is portfolio lenders, portfolio loans. I specifically say local lenders, and the reason why I say that is that there is money, obviously, from different sources. These are bank money from lots of different institutions. It could be the big box type companies, whether it be like the Wells Fargo's, Bank of America, Chases of this world. These are large, outfits that are national or regional in nature. The problem I had with these institutions is that they tend to be, I don't know, it's just it's harder to deal with those guys. Why? Because decisions aren't made locally; they're made somewhere else, and as a result of that, it's hard to develop relationships because the people that you develop relationships with aren't really empowered to make the decisions. So I really stress the importance of local lenders. These are small regional banks, lenders. They're not the big ones, but they focus on a specific geographical area. It could be a city, state, regional focus, and that's where they do business. That's what they know. That's where they most of the transaction actions are there, and so as a result of that, a lot of the decisions are made locally. So so portfolio lenders is something which I really think is worthwhile to explore. Now, what are the pros? Well, first of all, who uses these sort of regional banks? I use them. Fix and flippers use it. So if you're pursuing a fix and flip strategy, definitely what's it called? Local lenders will be a way to go. Buy and holders like myself, and also developers who do kind of condo conversions and things like that. They tend to do a lot of local, tend to use a lot of local lenders. So what are the pros of going to banks to get your financing in terms of uncertainty, in times of uncertainty like what we're in now? What are some of the pros of that? Well, first of all, the pro is that what's okay? I said decisions are made locally, and therefore you can generally develop relationships with people. You can get to know them; they can get to know you. You can take the time to explain your business. You can understand what they're looking for, and generally you can, especially if you have what we call a credibility kit, which is something I've developed. And you can get one, a sample credibility kit from my website. You can buy one. It's a pretty good one. What it does essentially is tells your story. Who are you? What's your background? What's your experience? What's your team? Why they should do business with you, and and why you're a good risk. So that's the credibility kit. And it's always good to have something like that ready, such that when you meet somebody for the first time, a bank or a lender or a potential private investor, which I'll talk about later on, you're able to, as I said before, share your story, tell your story, and to sort of differentiate yourself from other people. Very, very few people have a credibility kit. Very, very few people have any documentation that tells people about their story. They just go to these meetings empty-handed and just talk. And I feel that it's really good if you can leave something with people. It's what we call a leave behind when you have these conversations with these people. It really does differentiate yourself from other lenders and so on. So that's the pros. The other thing is that because decisions are made locally, there's some flexibility. If there's a gray area between you and a yay or a nay, there's a gray area sometimes whereby there's some discretion that these folks can have. And whereas the big box type banks, if you don't fit exactly into their mold, it's more than likely the loan is going to get declined. Local banks can sometimes close fast, depending on your situation. Sometimes it's 2 to 3 weeks, where some of the larger big box banks is 30 to 45 to 60 days. So speed is also a pro, a good thing. And as I said before, there's a bit more flexibility compared to some of the larger conventional banks and so on. So these are the pros of the portfolio lenders. I mean, I can talk about this quite a bit, but let me just keep going. The cons or the downsides of some of these local banks, sometimes, not always, but sometimes, their qualification requirements can be a little bit burdensome. Most banks, because they're federally chartered, there's certain documents that they have to have from you. So it's what we call a full documentation process that you have to go through. So you've got to have the documents that they need. If you don't have them, then it's highly unlikely you'll get approved. So that's the reason why I say it's always a good idea before you meet with these folks is to try to understand what it is that they're going to need from you, and that way you can take the time to prepare and have all your documents in order, such that when you meet with them, you can sort of impress them that you got your stuff together, you got your act together. I used to put I have a binder which I would sort of put all the documents that I know the bank's going to need organized in sort of what do you call that thing? Page separators, and it looks pretty good. So that's what I do. So it's full documentation is probably a con, if you want to consider that. Sometimes these banks they have shorter term loans. It could be a year, especially on the rehab loans, 6 months to a year, whereby the loan is good and for 6 months to a year, and then you're going to have to either refinance or or what we call re-up. So if your project can't be completed in 6 months, especially if you're doing a rehab, 6 months to 12 months, you may have to go back and sort of extend the loan. And most times they do. They at least give you one extension, but there's no guarantee. So I would consider that to be a con. Another con would be, they like to do business with people who have some level of experience. It is what it is. And these are federally chartered institutions. And therefore, if you're a complete newbie, it's a bit more challenging to get financing from these banks. I mean, I'm not saying it's not possible. It's definitely possible because we all have to start from somewhere. But generally, what's it called? They like to see people with at least have done at least one deal or several deals in order to do business with you. But I wouldn't put that as a showstopper. It just varies from bank to bank. It's also your ability to demonstrate to them that you got your act together, you know what you're doing, and that you're a good candidate, you're a good risk on their from their perspective. And interest rates. I mean, at least compared to conventional loans like your Fannie Mae, Freddie Mac type loans, the loans here are usually higher. The rates are slightly higher than what you can get with Fannie Mae financing. With commercial lending, it's usually variable. It's fixed for maybe 5, 7, or 10 years, and it's amortized typically over 25 years. So the interest rates are slightly higher than, say, the Fannie Mae conventional type financing. So that's for portfolio loans from local bank. Again, I can go through all of this in much more detail, but we don't have time. So that's the pros and cons for the local lender. The next one I want to talk about is what you may be familiar with is what we call hard money lenders. And hard money is a term that's used for lenders who do what we call asset-based lending, whereby a big factor in whether they borrow you money is how it's got to do with the actual property, the asset that they're going to lend on. On the banks, a lot of it is based on you. Your credibility, your track record, your credit, and things like that. Whereas for hard money, yes, it's important, that you have credibility, but a lot of the decisions is made on the strength of the deal, the asset that you're asking them to fund. So who uses this kind of hard money lenders? We all use it. Fix and flippers, buy and holders, especially if you're going to do the BRRRR strategy, the buy, renovate, rent, refinance, repeat process. A lot of BRRRR investors, they use the hard money on the front end, and then they refinance once the project is complete and the house is rented with a tenant. But the first part is, many times people use hard money, and obviously developers, again, people who do larger buildings and so on. So we all, as investors, are familiar with and we use hard money. Now the question is going to be, where do you find these folks? There's a lot of them around. And you can go to RIA meetings, Real Estate Investment Association meetings, to get some names. There's a lot of them that sort of advertise in Bigger Pockets and other sort of investor outlets. And there are local hard money lenders, and there's also national hard money lenders. I think I've done two. I've done hard money twice in over 30 years I've been doing business. I tend to use banks as opposed to hard money, but I've used hard money in the past, and they charge a little bit more, but they get the job done. They can usually move pretty fast, and they get if you pick a credible hard money lender, they can get the job done. So what are the pros again? First of all, they're easier. Their lending standards are generally easier than a bank. It's not as much hoops that you have to go through, getting a hard money loan than going to a traditional bank. They can definitely close fast, at least faster than a lot of banks. I know when I did the last time I used a hard money, we were able to close in 3 days. I mean, it's crazy fast. And why in that deal, I think if I remember right, I bought a house. Well, I had a contract in the house, and the seller had kind of cold feet about wanted to sell it to me. And but we had it under contract, and the seller says, you don't close in 3 days, which is the term of the contract, I'm going to cancel the contract. And it was a good deal. So my regular bank, they couldn't close that fast. They could close in 2 weeks, but they couldn't close in 3 days. So I was referred to a hard money lender, and lo and behold, they got the job done in 3 days. They funded this whole transaction over 6. That's the acquisition and the renovation. It was crazy fast. Anyway, they can move fast. And again, depends on your relationship with banks. Hard money lenders. Sometimes their rates are high. Yes, they definitely are. But you can sometimes negotiate, with them, or you, especially if you do several transactions with them, then you can sometimes bring down the rate and get more favorable terms. So there are advantages in building a relationship with specific hard money lenders versus just going to a different one each time. What are the cons, the downside to hard money lender? I think we all know most of these. The big one is obviously it's expensive. It's not cheap money. I think nowadays the rates are like 12, 13, 14, 15%, which is pretty high compared to a bank, which is more like 6 and 7%. So as you can see, it's not cheap money. It's expensive money. And I generally don't use hard money unless I have to. But if you have to start somewhere, if that's all you can get, it is what it is. You start there. It's better to at least do a deal than not do a deal because you're kind of worried. So it's expensive in terms of the interest rate and the points and the terms. And the other downside, it depends on the type of hard money lender you go to. Some of them are, I would just say, less than, what's the right word? Less than sincere. How about that? What I mean by that is that some of these shady ones, hard money lenders, their goal is just to take the house back. And so they kind of set you up for failure. They won't renew when the term expires, or the draws. When you need it, they kind of drag their feet, and which means that your contractor is getting upset because they want to get paid because they've completed at least their part. But your hard money lender is taking their time, dragging their feet to release the funds. And if they're dragging their feet to release the funds, you may run into a cash flow problem. And so, I mean, again, most lenders are ethical, honest, high integrity, and no issue. But there are some really, I would say, shady ones out there who, they want your house. That's all there is to it. And this is a backdoor way of getting your house by giving you a loan that and having terms, or the process is so unwieldy where you're almost set up to fail. So be careful about that. I would strongly recommend that you go to hard money lenders with people that you can get referrals. You do your due diligence on them to make sure what their terms are and conditions are, and and it's not just buried in these sort of 6-point font in about a 30-page or 50-page document somewhere. So just be careful about that. So there are some hidden fees, especially if you have to, extend the loan because it's taken so long, or taking longer than what you expect it to be. Mm-hmm. So that's a downside to the hard money lenders. So I've done 2 so far. I've done the what's it called, portfolio lenders, local lenders especially. And I've also talked about the hard money lenders in terms of what they are, who uses it, the pros and the cons, and so on. So again, we're going to do a Q&A shortly. So if you got some questions, put them in the chat box, and I'll be more than happy to try to answer some of your questions towards the end of the session. If you got any questions to do with money, now is the time to kind of let's put them up, and I'll see what I can do to address any question that you may have. Unless you have all the money that you need, and you don't need any more money. I know we've got some pretty wealthy people in the audience, but if you got any issues with money or need a guidance, advice on raising money during these difficult times, please enter your questions in the chat box and I'll try to get to them. Today's session hopefully is going to be a little bit shorter. We don't need to go through a whole hour, but I'll stay until the questions are asked. The third one I want to talk about is private money. And private money is a term, that's pretty common. And the way I describe it is rented to regular, quote unquote, regular folks. These are people who aren't in the business of borrowing money, because some people may call hard money as private money, because typically what these folks do, they take money, well, not take money, they borrow money from individuals and they package it together and then sell that money to you, or lease that money or rent that money to you with their cut on it. So that's typically hard money. Private money is you're going straight to the source. You're going straight to individuals, people, without having to go through a middle person, a middleman, middle woman, or whatever. And so I'll delve into that in a bit in a couple of minutes. But who uses hard private money? The same people, fix and flippers, buy and holders, and developers. I use private money. I've used private money a lot over the years. When I first started, I was kind of leery. I was kind of scared. I was sort of wondering who would want to lend me money, who would want to lend Dr. Joe money, and then I realized that there's people out there who are tired of getting 0.1% rate of return from their checking account or from their savings account or whatever it is, and they want a better return because inflation is at 6 or 7%, and the banks are paying for deposits like 1%, some crazy number. So they're really worse off. And so there are people out there who want a better return, and so, but what I found is for private money individuals is that they're not in the business of lending money. However, they're not just going to give their money to you, their hard-earned money to you, just because you want it. They're going to do their due diligence. It's based on the relationship. It's based on how comfortable they feel about you, and and how comfortable you're able to explain to them how they're going to get their money back. Okay, that's on you to explain to somebody how they're going to get them. Well, first of all, how they're going to get their money back, the money that they're giving you, and also how you're going to get them the interest that they've accrued during the time the money was with you. So that's your job, is to be able to articulate that, because if you can, then that's a good start. If you cannot, and you're kind of ducking and diving and kind of mumbling words and looking down and kind of sorry for yourself, you're not going to raise any money. People can see right through that. And but I've been able to raise quite a bit of money from different individuals over the years in order to fund my deals, and it's been very, very successful. And that's what allowed me to really escalate, fast track some of my acquisitions and renovations and holding, is because I wasn't using all my money. I was using some of my money, some banks' money, and some money from private investors. When you couple those three together, especially in this market around the DC area where it's just so expensive, where you're buying stuff for 4, 5, 6, 700,000, that's a lot of money, and it's hard to raise that kind of money without going to third parties and so on. Also, if you're trying to do it all yourself, at some point, pretty quickly you'll run out of money. So private money, it's really it's your ability to to explain to people what are the benefits of borrowing you the money, lending you the money, versus whatever else they may be doing with that money. And these could be friends, family, neighbors, colleagues, these just quote unquote average people. And they're out there. There's also a lot of people with what we call self-directed IRAs that you can probably tap into. Self-directed IRA compared to a traditional IRA is that, or 401k, is that it's in an account in an institution whereby you can more direct where that money is going. The traditional 401k, you've got a whole bunch of different options that you can sort of put your money to. But it's usually securities like stocks, mutual funds, um, you know, uh, exchanges, and things like that. But with a self-directed IRA, you can direct that money to at your discretion to other things, other asset classes, whether it be real estate, whether it be notes, whether it be it's just lots of different ways where you can put that money. So there's a lot of people, as I said before, who have self-directed IRAs, and you certainly can use their self-directed IRA to borrow against, and that's what I've done many, many times. Some of the pros of what do you call it? Uh, Private money. It's much easier lending standard because you're dealing with individuals. They are typically, they're not professional lenders, and so their qualification requirements, it's generally anyway, it's a bit more easier than banks or hard money lenders. It's all about relationships. It's about your ability to project, what you're doing, and allay any concerns that they may have. I know it can be a little bit intimidating, but you'll be surprised. There's a lot of people out here with money. They're not going to advertise they got money, but they have it. And it's if you're in need of money, then obviously you have to be able to convince a potential private lender that you're going to be a good steward of their hard-earned money. So at least when I'm doing private money, it's on me, my integrity, my track record, my experience is what these folks are buying into. And so a lot of it is on you and your ability to communicate, why they should lend money to you. A lot of it's based on relationship building. So you're gonna have to get out there, meet people, talk to people, let people know what you're doing, and you'll be surprised. And there's a bit more wiggle room in private money compared to hard money or banks in terms of determining the terms of the money. So you can negotiate things like the interest rate, when payment is due, and points. That's some of the things that you can sort of negotiate. So there's a bit more wiggle room, in terms of when you're using or borrowing money from private individuals. The cons are the same thing. The cons are your track record. Are you a person of integrity? Are you a person that's going to do the right thing? Are you the person that's going to do what you say you're going to do? It can be a little intimidating. I'm talking about the cons now. It can be a little intimidating, especially if you haven't done it before. You may have some self-doubt, and it's a little scary. I get it, and but I'm not saying that if I can do it, anyone can do it. No, I'm just saying that it's not as scary as what people think it is. I mean, I was scared, but I overcome my fear. I overcame my fears and went out there, had my credibility kit, had my talking points, and lo and behold, I was surprised that people started, borrowing me money. And so now I have a pretty decent list of potential private investors who help me when I, by bringing money to the table when I do deals. So let's talk about my final thoughts because it's kind of getting 7:35 now. Final thoughts. So if you got some questions, put it in the what do you call it? The chat box, and I'll try to get to them shortly. So final thoughts here. Money is really, really important, especially during a downturn. There's going to be some good opportunities, and the market will come back generally. We don't know when. It could be months, it could be years from now, but it usually will come back, depending on where you are geographically. And so now's the time to get in, especially if you sort of pursue the buy and hold strategy that I'm a proponent for. So that's really important. But obviously, in order to do deals, you need money. And so if you're a new investor, here's what I would suggest. Okay, some action items. One, work on yourself first. You're going to have to allocate some time for education and training. We all have strengths and weaknesses, so you need to understand what your strengths are, what your areas of weaknesses are, and you have to decide kind of what your focus is going to be, what area you're going to focus into what niche in real estate investing you're going to focus on. We all know that I focused on buy and hold strategy. I was doing BRRRR before BRRRR was even invented, but I wanted to hold on to houses versus just selling them for the sake of selling them. I wasn't interested in flipping, and I wanted to control and own the asset. I wanted to be on title. I wanted to be the legal owner of these assets because I felt that these were appreciating assets as opposed to depreciating assets, which is what most people tend to spend their money on, depreciating assets, stuff that's going down in value over time. So next thing is deciding your area of focus. And once you decide your area of focus, I think the next thing is to learn the basics of that, whatever that may be. You can't learn everything. If you try to, you'll end up, I will say, analysis paralysis, where you won't do anything because you're just waiting to learn something else. At some point, you know enough. It's now time to pull the trigger. So the best thing to do if you're going to pull the trigger, I think, is to identify and work with an experienced mentor, somebody who's successfully doing what it is that you want to do, and someone that's navigated downturns in the past, and therefore they're not going to be completely surprised or shocked when they get hit by curveballs or surprises. As the saying goes, a wise man learns from his mistakes, but a genius learns from other people's mistakes. So get on, and then just get onto it. Get on to your next deal, your first deal. Make it happen. It's not going to be easy. It's going to be difficult. It's going to be challenging, but you can do it. And also focus on building your credit, making sure that you're quote unquote bankable, and develop relationships with money sources. And the other thing is, a little tip is that if you've got some underperforming assets, underperforming properties that you kind of, you're not really that intrigued by or impressed with, now is the time before the market really tanks, is to get rid of them. It's a little market slow, but if they are a burden on your portfolio, it may be time to offload some assets. So I would suggest you kind of revisit your assets, revisit your portfolio, do what we call a stress test on your portfolio, and to identify some properties that if you had the opportunity, you could sell and move on. So that's really, my final thoughts. And hopefully today was helpful. I'm going to kind of go to the Q&A session now. So if you've got some questions, please enter your questions in the chat box, and I will try to get to them. And so on. Likewise, if you want to email me, then you can email me at joe@joeasamoah, and I'll try my best to reach out to you. I will be starting I'm really excited. I'm going to start another program very shortly, focused on helping people do deals. It's a bit lighter on the individual education, but more focused on helping you get a deal and then helping you implement that deal from start to finish. That's where the focus is going to be. I just enjoy working with people who are doing deals, who pull the trigger and are taking action, as opposed to just people who generally just gather information but don't actually do anything with it. There's real opportunities in current times where if you can execute, if you can pull the trigger, you may be able to get some good opportunities. Okay, so let's kind of go to the Q&A. So let's have a look, and I will now go to the comments. So let's have a look. Who's here? We got good morning, Marlon. Hi, Marlon. Hope you're doing well. And hope all is going well. I hope that you spoke to the folks today. I'm not sure if you did. I saw your email. Hopefully you're able to catch up with them, and hopefully the outcome was positive. And keep me, let me know. Feel free to provide a summary so that maybe I'm leery of sharing too much information. But hopefully everything's moving along well, as we discussed earlier this week. Okay, let's go to Johnny H. Hey, Johnny. Would it be best to establish a relationship with a local bank in your area or the area where the investments are located? I would say it's best to where the location of where the property is, because just because you develop a good relationship with somebody in Washington D.C., for example, and you're buying houses in Texas, it really doesn't matter because they're not going to lend in Texas. So it's pointless developing relationships. If you're buying in a completely different area, because many times, especially banks, they're not national unless you got the big box banks. But most local small lenders are local. They have a geographical coverage area, and they don't generally lend outside of that. So you want to zero in on the area where the investment is or are located in terms of developing those relationships. Okay, hope that was helpful, Johnny. Again, if you got some questions, please put them in the chat box, and I will try my best to answer as many of them as possible. Okay, this is from Ms. Okay, thank you for this information. If you were to start over again, what would you do different as a beginner? Well, it's a good question, and I think I tried to summarize that in my closing thoughts. If I had to do it again, I mean, because when I first started, I just bought a house. I didn't know what I didn't know anything. I really was naive. And I got burnt big time. I got ripped off a few times as well. I didn't, because sometimes you don't know what you don't know. Ignorance is not bliss. You just don't know. And so I would suggest if I had to do it again, I would sort of, I definitely would have taken time to work on myself first, just to get some basic education, basic knowledge, basic understanding of my criteria, develop my criteria. Where do I want to buy? What's the criteria for purchasing this home? I wish I had surrounded myself with people that were more successful than me, because I didn't know anybody, and or even just being around people that were doing something similar to what I was trying to do. That camaraderie, I just didn't have it, and so I was kind of just going in the blind. I didn't have a mentor. I bought one of those guru. At that time, it was called tapes, cassette tapes. But the guy was, I don't know, I think he's based out of Hawaii somewhere. And his infomercial was him in the background in Hawaii with speedboats and all that stuff. You too can do this. All you gotta do is give me your credit card and you'll be fine. Which I did, and obviously, that wasn't it wasn't as simple as that. So what would I do differently? Yes, definitely. And I would. One thing I'm pleased of though, I did pull the trigger pretty quickly. Maybe because I didn't know what I was doing. But one thing I regret is I wish I bought more properties. There's some houses which I sold, which I really, really regret. And I just wish that I kept a lot more houses, and then develop my team, build my team, work on my relationships, and just become an expert and knowledgeable about dealing with tenants, how to select tenants. I didn't know any of that stuff, so I was selecting tenants who would talk a good game. I'll fall for it, and next thing I know, they're in my house and I can't get them out because they're not paying my rent or whatever they're doing. So there's a lot of things I could do, and hopefully, like I said, I didn't have a mentor. I didn't have a Dr. Joe at that time. You do, so you may want to leverage on people like myself who have real world experience who can help you, and so hopefully help you avoid making what I call unnecessary mistakes. Hopefully that was good, Ms. I don't have your name, but thanks anyway. Let's have a look. Cars and crypto. Can you explain a DSCR loan? Is it hard to get an FHA loan if you are not a first-time home buyer? Okay, cars and crypto. Can you explain a DSCR loan? Okay, DSCR loan is called DSCR is debt service coverage ratio. Debt service coverage ratio. What that is, it's a commercial loan, typically done by commercial lenders, whereby, okay, let me just step back. When you are applying for a residential loan, typically they look at things like your credit, your pay stubs, all the usual stuff, okay, to determine whether you qualify, and if so, how much. For a lot of commercial loans, it's based on the cash flow that the asset generates, and the debt service coverage ratio is the ratio between the payments, the debt, and the income that you get. So let's say the rent. So let's say the mortgage is $1,000. Let's say then, and your rent is 1,200. Let's say then the debt service coverage ratio is 1.2 divided by 1,000, which is 1.2. So sorry, 1,200 divided by 1,000. I'm sorry, which is 1.2. So debt service coverage ratio is that. So the bank wants to know how much extra do you have as a percentage after you've paid the debt, okay, in terms of cash flow. And they have criteria as to how much they'll lend you, or in other words, how much cash that the asset must generate in order for you to borrow against. So a lot of commercial lenders is based on the amount they give you or borrow you is based on two things. One is the appraised value, and the second thing is the debt service coverage ratio, how much extra cash flow is generated by the asset compared to the debt that you are borrowing. So that's the first part. Can you explain? I hope that was helpful. Is it hard to get an FHA loan if you are not a first-time home buyer? It's hard to get first of all, you cannot get an FHA loan unless it's your primary residence. So if this is not your primary residence, you're not going to get an FHA loan. However, if it is going to be your primary residence, then you can definitely get an FHA loan if you meet their criteria. And if you're a first-time home buyer, you definitely can stand a chance. You're going to live there. Then there are definitely advantages of going with FHA. The down payments are lower. It could be anywhere from 3 to 5% down, as opposed to 10, 15, 20% down, or 25% down on on an investment property. It's a great to do your BRRRR strategy because you're going to live there, and so it's going to be a primary residence, but also you can generate some income from the asset or from the property. So but the fees I think are generally higher with FHAs, and there's a lot more hoops that you have to go through, and also in terms of the loan process. As my understanding is that the appraisal is a little different and can be a little bit more taxing. And I know sellers, if given the chance, would rather not have to deal with FHA versus a conventional, type lender. So yes, so is it hard to get FHA? It depends on your credit. Your debt to income ratio. It depends on your ability to provide all the documentation in order to satisfy the underwriting conditions. So that's where that goes in. Hopefully that was helpful. Cars and crypto. Okay, Shep the PE guy. Okay, great point. I'm not sure which point you were talking about, Shep the PE guy, but hopefully it was a good point wherever I made. So, but feel free to let us know what point you're referring to. Let's have a look. Johnny H. Is it tougher to provide a good return for the private investors with inflation being higher? Is it tougher to provide a good return for the private investors with inflation being higher? Inflation is higher. Obviously, because inflation is higher, banks are raising their interest rates, in order to entice some of these, people with money. So you may not have to raise the amount of money that the interest rate that you're prepared to pay back for private money during these times. I'm not, but you have to you know you have to sort of explain why you're a good risk. Why should they bring their money to you versus take their money somewhere else? So that's what I'm saying is that your challenge, if you're going to go with private money, it's all about you. It's about why should they want to do business with you? Are you trustworthy? Are you going to do what you say you're going to do? Are you going to protect their hard-earned money? Why should they do business with you? These are questions that you need to answer yourself, so that way, when they come up, you can give good answers and not be sort of flustered. So yes, you may have to increase your rates because the inflation is getting higher, and but the good thing about private money is that you don't have to jump through as many hoops compared to, say, banks, and that's why a lot of people like private money and so on. So hopefully that was helpful, Johnny. Again, it's nice talking to you. I think it was yesterday I spoke to you, Johnny. Hope all is well with your house in DC. Okay, Lady Bell. I live in my own home in DC and I want to buy my first investment property. How can I join your next training program? Oh boy. Best thing to do, Lady Bell, is to shoot me an email, and you can reach me at joe@joeasamoah.com. Let's see if I can pull that up on the screen. It is this one. You can email me at joe@joeasamoah.com, and and then if you put some contact information, then I can reach out to you and we can talk and see if I can be of assistance. I'm going to start a new program very shortly. It's going to be a great program. It's focused on helping me, well, not helping me, it's me helping you. You're leveraging my 30 years worth of experience to do deals. That's what we're going to do. We're going to do deals. It's your deal, but I'm going to provide the infrastructure in terms of the deal, the money, and the team, and also my relationships with different housing authorities, to get good quality tenants, so you get guaranteed rent. So that's all it's going to be coming shortly. I'm really, really excited about that one. So, hopefully you can be part of it, Lady Bell. And as I say, you can give me a call or shoot me an email, and then we can give me your contact information, your email, and also your telephone number, and maybe we can schedule a Zoom call in the near future. Let's have a look. Let's have a look at this one. So again, if you got some questions, please put them in the chat box, and I will be more than happy to answer them. Drumpty Dumpty. Hi, Joe. Chester here. Good to see you. Drumpty Dumpty. Who's Chester? Is this Chester that I know from England? Is it? I don't know if it is. It'd be a shock. If it's you, Chester, let me know. I definitely. Wow. This is. I don't know if this is the same Chester that I knew in England many years. In fact, I went to school with him when I was at elementary school, I think they call it here. So definitely would like to catch up with you, Chester, if it's you. And hope you're doing well. Anyway, and if it's the same person, this is I used to live in a place called Nottingham in England. They call it Nottingham there, but and Sherwood Forest and those guys, Robin Hood. That's where I used to live many years ago when I first came to England from Ghana, and Chester, I think if it's you, we used to go to the same school, elementary school. My goodness, this is way back. Anyway, let's have a look. Lady Bell. Okay, thanks. Let's have a look. Johnny H. Awesome information and answers are always. Thank you, Dr. Joe. You rock. Okay, thanks, Johnny. And it's getting close to 8 o'clock. So I'm going to kind of wrap it up for today. Hope all is well for everybody. I'm really excited by the next coming few months as we what's it called, as the downturn hits in, and there's going to be some good opportunities. If I can be of assistance to you on your journey, please let me know, and definitely try and help you out. Real estate's a good business, and if you know what you're doing, if you do the right thing, it can definitely be a vehicle towards financial independence, and so on. So with that said and done, I'm going to if you need to, I'll put my email up again. Let's have a look. It goes here. There we go. So if you need to email me, shoot me an email. I'll be more than happy to talk to you, email you, and maybe, oh, another thing, if you got some ideas on topics that I can talk about next or future Wealth Wednesdays, please let me know. And I definitely, like to put them up there. I got quite a lot I want to talk about in the next few weeks, but if you got some ideas, please fire away, shoot me an email, let me know some topics that you'd like for me to address during the regular Wealth Wednesdays. So with that said and done, I want to wish you all a good evening, and I will see you next Wednesday at 7 p.m. Eastern time, wherever you are. So have yourself a wonderful night, and I'll speak to you guys later. Take care. Bye.